Hi, in this short video tutorial we're going to look at income statements. Hopefully I'll be able to explain the basic principles of income statements in under 10 minutes. In this example we're going to look at income statements which have a trading account and a profit and loss account. The income statement tells whether the business has made a profit or loss for the period under review. Profit is calculated by deducting expenses from sales revenue. So it's quite an easy concept. You have your sales revenue and you take away from your sales revenue all your expenses and you end up with your profit. In this example, we're going to prepare an income statement for a trading company or a trading business. In other words, we're looking at a business that buys goods in and sells them on, and not a service business. The income statement of a service business is slightly different. So, in this example, in order to ascertain the profit, two accounts will be prepared. One, the trading account, and two, the profit and loss account. The income statement is made up of these two accounts. In other words, the trading account and the profit and loss account. So the two of them combined make up the income statement. The trading account is where we calculate the gross profit, i.e. the difference between the sales revenue and the cost of sales. Cost of sales, or sometimes the term cost of goods sold, is used. The two terms are interchangeable. The profit and loss account is where we calculate the net profit. The net profit is arrived at after deducting all expenses from the gross profit. The income statement, in other words the trading and the profit and loss account, is normally prepared for a period of time, showing the summary revenues and expenses over a period of time. Usually the period of time is 1 year, but it doesn't have to be. It could be for a period of 6 months. The heading of an income statement for a business that had a financial year ending the 31st of December will be stated as follows: Income statement for the year ended 31st of December. Firstly, we will look at the trading account part of the income statement. Remember, the trading account is where we calculate the gross profit, i.e. the difference between the sales revenue and the cost of sales, or, if you prefer the term, the cost of goods sold. Remember, as I said earlier, they're interchangeable terms. We will take a little example here. So the following information has been extracted from the books of Mr. Green, a shop owner, for the year ended 31st of December. So in the shop, Mr. Green buys in goods and he sells them on. On the 1st of January, that's the start of Mr. Green's year, Mr. Green had €15,000 worth of inventory on the shelves of the shop. That's his opening inventory. During the year, he purchased €210,000 worth of inventory to sell in his shop. And at the end of the year, the 31st of December, he counted and valued the inventory on his shelves. It was valued at $20,000. That is his closing inventory. In the course of the year, he had sales of $290,000. So from this information here, we're going to draw up the trading account. So let's start off. We're going to have two columns. For presentation purposes, nothing to do with debits or credits. And we're going to have the sales revenue, and then from the sales revenue we're going to deduct the cost of sales or the cost of goods sold, whichever you prefer. Now the slight issue here is we don't have a figure for cost of sales, so we have to work it out. And the cost of sales is worked out as the opening inventory plus the purchases less the closing inventory. So those three items there will give us the cost of sales, and then we'll take the cost of sales away from the sales revenue to arrive at the gross profit. So in presentation terms, what I'm going to do is I'm going to put the sales revenue figure out here on the extreme right hand side, and then I'm going to step into this column to calculate the cost of sales. So I'll put in my opening inventory, 15,000. So remember they're the goods Mr. Green had on the shelves on the 1st of January. During the year, he buys in €210,000 worth of goods, which means he had €225,000 worth of goods in total available for the whole year. And then at the end of the year, he counts what's left over. It comes to 20,000. So the closing inventory is the goods that did not sell during the year. So they're not at cost of sale. So what I'll do is I have 15,000 plus the 210,000 minus 20,000. I'll bring that over here, line it up underneath the sales figure, and I'll get the cost of sales of 205,000, which I take away from the sales, and I get a gross profit of 85,000. So we have the gross profit figure here of 85,000. Now we will look at the profit and loss part of the income statement. The profit and loss account is where we calculate the net profit, and the net profit is arrived at after deducting all expenses from the gross profit. So remember, at this stage we actually have the gross profit now. So we will continue with the Mr. Green example. Mr. Green made a gross profit of 85,000. We calculated that earlier. Gross profit is the profit he made on buying and selling inventory. But he also has to pay the expenses incurred to run his business. Typical expenses, but not a comprehensive list, would include rent, utilities such as heat and light, wages, selling and advertising. Now continuing with the Mr. Green example, Mr. Green made a gross profit of 85,000. The following expenses must be deducted from his gross profit to arrive at his net profit. So I'm just going to put figures on those expenses we mentioned a few seconds ago. So rent, let's assume it's 15,000. Utilities, heat and light come to 12,000 for the year, remember. Wages, 25,000 for the year. And selling and advertising expenses come to 10,000 for the year. Now we're going to pull this all together into the income statement. So earlier we had the trading account. This bit here. And we had the gross profit of 85,000. Now what we're going to do is we're going to write in here less the expenses. And I'm going to list the expenses. So I'll have the rent, but I'm going to list them in this column here. 15,000. The utilities, and then I'm going to list this directly underneath the rent figure, 12,000. The wages, 25,000. And selling and advertising expenses, 10,000. Now I'm going to add up these four items here, and I'm going to bring them out over into the second column here, the right hand column, and line them up underneath the gross profit. So those four items come to 62,000. So then I'm going to have my gross profit less my expenses, and they will give me the net profit figure, which is 23,000. Okay, so that is our income statement. The first little bit up here, we have the trading account, sales less the cost of sales gives us the gross profit. Then we have the profit and loss account part, gross profit less the expenses gives us the net profit. The whole thing together is called the income statement. Thank you for listening, and I hope you found the short video tutorial beneficial.